Hello and welcome. We're pleased that you've joined us for today's session, Navigate Tax Planning for Healthcare, Prepare for OBBBA, also known as the One Big Beautiful Bill Act. This is the first installment of our Vitals and Vision Healthcare Strategy for the OBBBA Era webcast series. Before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about that through the link in your console. And now I'm going to play our housekeeping video.
Welcome and thanks for joining us. Moss Adams webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves, and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have a fantastic lineup of presenters with us today. We have Chris Bell, Lauren Haverlock, and Mary Antonetti, all principals at Baker Tilly, and Sarah Buhl, Managing Director for Baker Tilly. Their bios and contact information are located in your webcast console. And now I would like to turn the floor over to Chris Bell to get the presentation started.
Thank you, Amy, and welcome everyone to this webcast. This has been fun to put together and to work with this great team. As we look at some of the tax planning implications specific to healthcare organizations related to the One Big Beautiful Bill Act. We're going to cover the background of the bill, some of the business tax provisions. That's where a lot of our time will be spent. We'll cover comp and benefits, informational reporting, tax-exempt and charitable giving provisions, individual and estate tax provisions, at least some of the highlights. And we're going to briefly talk about some of the healthcare revenue and reimbursement implications in the bill. I do want to mention from the get-go that this is a lot of information to cover, and this webinar is the first in a series. This is intended to highlight some of the key changes in the bill, but the next broadcast or the next webinar, which will be on August 13th, is going to be a roundtable discussion around some of the implications of the bill. So more of a deep dive into how some of this will impact our healthcare clients. I want to give a little bit of background on the One Big Beautiful Bill. first of all, without going into too much detail, the One Big Beautiful Bill was set up when the 2017 Tax Cuts and Jobs Act tax reform law was passed in December of 2017. Many of those provisions were temporary. And so they set up this scenario where if Congress didn't act and those provisions expired, there would be an extraordinary hike in taxable income, or excuse me, in tax burden on taxpayers, beginning really in 2026. And so both Democrats and Republicans campaigned on extending many of the provisions that were in the 2017 tax reform law. It would have looked different under a Democratic regime, but they both ran on some version of tax reform. We knew that this would be important. Some of the key issues is there was a House version of the bill that was passed. Later, the Senate passed a very different version of the bill. The Senate's version was adopted in full. So if you're looking at some old news reports about what's in the One Big Beautiful Bill, reports about what was in the House version may or may not have made it into the final version. And that's important to remember. President Trump signed it into law on July 4th, 2025. And one thing that we're going to do just to make it easier to talk about is instead of referring to it as the One Big Beautiful Bill throughout, which is a mouthful, we'll also refer to it just as the 2025 Tax Act or the Tax Act. And with that, I'm going to turn this next section over to Sarah Buhl.
Thank you. All right, we intend to speak to at least high level the business tax provisions that are relevant to many healthcare companies. And we are going to start with tax depreciation. So bonus depreciation and Section 179 changes. These provisions are relevant to healthcare companies that purchase depreciable property. So I think of medical groups, dental practices, management service organizations, and a lot more. And in prior tax laws, bonus depreciation would phase out or sunset over time. But now with the Tax Act, 100% bonus depreciation in the year purchased is permanent tax law. And this is effective January 19th, 2020. Also, the maximum amount a business can deduct under Section 179, also tax depreciation related, has been increased. And the phase out threshold has also increased under this Tax Act. So both bonus depreciation and Section 179 expensing are tax planning opportunities. And what makes these rules so helpful with tax planning is how easy it is to take 100% expensing or elect out entirely or do something in between. So please note the planning tip box on the slide here. This is a reminder to consider how this tax law change could impact your 2025 projections, your 2025 quarterly income tax estimates. And as well, we're highlighting the benefits to cost segregation studies. And we do want to point out that not all states will follow the expanded depreciation provisions. So raise awareness around that. Changes to the research and experimental costs, Section 174 under the IRC. The Tax Cuts and Jobs Act of 2017 eliminated the option for immediate deduction of research and experimental or R&E expenses, and it required capitalization and amortization of those costs for tax years 2022, 2023, and 2024. And now under the 2025 Tax Act, there's a newly added code section that reverts back to the pre-Tax Cuts and Jobs Act rules, which again allows for immediate deduction of some of these expenses beginning in calendar year 2025. And there's a lot of detail on the slide here, and we don't have time to go over all the detail, but I'm just going to hit a couple of really high points, and you can pursue more information if you need it. Section 174 rules are highly relevant to digital health companies, health technology, telemedicine, MSOs, but also to small businesses and any business that's purchasing customized software or the costs associated with the implementation of EHR, electronic health records. All that's relevant here. So to change from the capitalization rules to deducting R&E expenses is treated as a change in method of accounting. And alternatively, businesses can elect to continue to capitalize and amortize these expenses for tax purposes. And so because we have these two options, that provides opportunity for tax planning. All right, so moving on to transitioning and implementation of these new changes. So transitioning out of Section 174 capitalization, it was required for tax years 2022, 2023, and 2024. We now have an option to elect to accelerate those unamortized expenses that were previously capitalized. So further guidance is needed from the IRS on the specific procedures to implement this, but please note that there's this option to accelerate deductions from those previously capitalized amounts, and that could very well impact 2025 tax planning or future years. And yes, please chime in, Chris.
Sarah, just a quick question. You mentioned that taxpayers have the option to continue to capitalize. Functionally, do you think that's going to be something that comes up very often, or do you think that would be pretty rare for companies to go that route?
I could see it being considered, but the reason I would think we'd probably stray from it in most scenarios is the compliance costs internally for the organization and externally for their tax providers to do the capitalization correctly. The compliance cost probably outweighs the benefit of the capitalization and the desire to push those deductions into future years. That would probably be the conversation I'd have with clients.
Thank you.
Yeah. All right. One more slide here about this before we move on. So we do want to raise awareness. There's a special allowance for small business taxpayers who were subject to Section 174 capitalization rules for these past 3 years. And that is to elect to retroactively apply this rule change to prior tax years. There were certainly instances of small businesses who were in a taxable income position in recent years, specifically due to this requirement to capitalize these R&E expenses. So that option is out there for that retroactive removal of capitalization for small businesses specifically. All right, last point about Section 174. It's not going away entirely. There's still requirements to capitalize certain expenses moving forward. There's a lot going on with these rules, and I just encourage you to look at your individual situation, determine what's right for your business, and speak with your tax professional about it.
Sarah, before we completely move on, one last thing. International research and development costs will still be required to be capitalized. And in healthcare organizations, historically, we didn't see this as often, but in the telehealth space, any company that has an app, it's not unusual for some of the programming to be done in other countries like Canada or India or elsewhere. Mm-hmm. And so we are seeing this more and more where there's an international R&D that needs to be capitalized and in that situation amortized over 15 years. Sorry if I'm selling the thunder on other slides, but just wanted to good. On that point.
I moved back, I navigated back 2 slides where it is included on the slide, but yeah, it's in the details for sure. Foreign R&E costs still must be capitalized and amortized over that 15-year period, which is unfavorable to taxpayers.
Thank
you. And Sarah, just one other comment, because I think you probably would agree that you still do have the R&D credit out there. While it's a different regime, it's sort of parallel. And those types of things really need specialists to look at. It's not something that clients will just make up a number. You know, someone's going to have to do actual studies on these.
Yes, R&D tax professionals specialize in the Section 174 and the Section 41 R&D tax credits. Thank you for highlighting that, Mary. All right, again, there's a lot going on here. I'm going to move on to the next topic, but please feel free to reach out with specific questions. The next business tax provision I'm going to highlight is the expansion of the qualified small or excuse me, the extension of the qualified business income deduction. That's a little bit of a mouthful. This is also called Section 199A, or the acronym QBI. And that Tax Cuts and Jobs Act of 2017 is what brought this code section to life. But the rules were going to expire or sunset. And now with the 2025 Tax Act, that makes this Section 199A permanent tax law. There's some new addition to the rules in the 2025 Tax Act. They couldn't quite just leave it alone. They had to add in a couple new things that could increase the benefit QBI deduction beginning next year, 2026. But I think the big point I want to make here is I just want to emphasize that healthcare professional services are considered a specified service trade or business. That's been in place since the Tax Cuts and Jobs Act. Specified service trade or business, in quotes, under these rules, the partnership or an S corporation that's providing that K1 footnote information to its partners or its shareholders, it needs to disclose whether or not that activity is considered a specified service trade or business or not. So that's why I'd highlight here, but good news that this qualified business income deduction is now permanent tax law. That's a benefit to business owners. Also a benefit to business owners, but the prior tax law is in a flow-through tax setting, partnerships and S corporations. This tax law is applicable to businesses that are organized as C corporations. So the expansion of that qualified small business stock, Section 1202, I think the first thing I'll say is these provisions are not simple and they should not be oversimplified. I also want to highlight that healthcare companies can be excluded from treatment of qualified small business stock if their primary function is providing services in the field of health. That's the language. Primary function is providing services in the field of health is not considered QSBS. But that QSBS treatment can apply to MSOs, DSOs, healthcare technology companies, medical device companies, and a lot more. So QSBS is highly valuable to the founders and the business owners that invest in the startups and the small businesses that are organized as corporations, because it allows for a significant exclusion on the eventual gain on sale of the qualified stock. And that's a great benefit in reducing capital gains tax to that individual. Okay, so and then about all the words that are on the slide. The 2025 Tax Act changed the rules around QSBS to make it more taxpayer and investor friendly. And this is highly relevant to investment strategy for small business owners, private equity, venture capital. Again, highlighting that there are very specific requirements. I included a URL to an article that talks about this in a lot more detail than the slide does. So please just seek out more information if this is relevant to you. All right, employee retention credits. I don't know if you've heard of this before. There's been a lot of talk about it for the last few years. Employee retention tax credits, I guess I think of it as a well-intentioned payroll tax relief credit. It was intended to provide relief to employers during the COVID-19 pandemic. But the rules and the procedures were very complex and they changed multiple times. And the IRS tells us that there was a lot of misapplication of the rules, as well as extensive fraud. And so there were a lot of promoters of the credit out there in the market and that were providing bad or misleading advice. And so coming out of all that, the 2025 Tax Act included 3 very notable changes to the employee retention credit, which we've highlighted on the slide here. So 1, claims for Q3, that's quarter 3, Q3 and Q4 of the 2021 tax year submitted after this specific cutoff date of January 31st, 2024 will not be processed by the IRS. the second item included in the act was the statute of the limitations for the IRS to audit those 2023 and 2024, or excuse me, Q3 and Q4 2021 tax year tax claims. That statute of limitations has been extended to 6 years. So that statute of limitations can also be impacted in the cases of fraud or misrepresentation. Third item in the Tax Act is that the IRS has been given specific direction on penalties that can be imposed on those promoters of the employee retention credits that were pushing the credit in the marketplace. So if you have Q3 or Q4 2021 employee retention credits or feel like any of this applies to you, I just encourage you to discuss your specific facts with your tax professional because there are new rules to be aware of.
Sarah, just a quick planning note. This comes up frequently in two contexts for our healthcare organizations. One is transactions. So if you're buying or selling a company, this is an area that's going to be scrutinized very carefully. And so it's an area to understand. You briefly referenced it, but if there was fraud or really misleading information, there are scenarios where the IRS has no statute of limitations. They can go back forever and on those kinds of issues. The other area is in the context of audited financial statements and whether or not there's been a reserve against that credit. Yes. In which we frequently see this issue come up.
Yes, thank you for bringing those points up. All right. Last slide on the business tax provisions before we move on to the next agenda. So this is a list, I'll give you time just to scan through it, of additional changes that could impact some healthcare companies. And so we don't have time to cover all the provisions, but we just want to raise awareness around the new market credits, the clean energy credits, changes to opportunity zones. There's a modification to business interest deduction limitation that if it applies to you, you would care about. Also, a lot of significant international tax items. Again, I put a URL here to an article that goes into those items in more detail that you can reference. And then we do just want to highlight that we're encouraging everyone to stay informed on those state and local taxes that impact your business. States, I guess, unlike the federal government that can run at a budget deficit, state governments often cannot. And so they're expected to have a balanced budget. And we're seeing a lot of state tax laws that are coming out that are increasing that state tax the state tax impact for businesses. So just another reminder that this is one of a series of webinars, and we can and we will cover more in the future, or you can reach out with specific questions. And I think with that, we're going to move on to polling question number 1, and I'll let Amy take that away. Thank you.
All right, thank you, Sarah. So the polling questions are located right on the slides that we're presenting. So if you can't see it, you may need to hit F5 to refresh your console. So the first of the 4 questions, tax planning for the business tax provisions of the OBBBA is relevant to me. And your options are A, strongly agree, B, agree, C, there's 1 or 2 items that I need to pay attention to, or D, disagree or not applicable. And then to respond, please click the button next to the answer you choose, and then make sure you hit that submit button. It looks like everyone's responding pretty quickly. We'll leave this up another 5 seconds or so. And here are the results.
Wonderful. Thank you, everyone, for providing. It looks like there's at least some information in the business section that's relevant to most of our team members. We're going to, or most of the people on this webinar, we're going to cover compensation and benefit provision information that's here. And we're going to start with an expansion of the 162M limitations on executive compensation. This applies primarily to publicly traded companies, and that's important, but there are applications to tax-exempt organizations, which we'll cover a little bit later, where there is certain compensation which might give rise to an excise tax for nonprofit organizations. There is a permanent extension of the paid family medical leave credit. So it permanently extends the availability of that credit. There's also, they made permanent the employer payments of student loans under certain conditions, and you can see that there's a cap annually on what you can do there. The bicycle commuting reimbursements are excluded now, and that's permanently eliminated starting in 2026. And moving expenses under the 2017 tax law, this was temporarily removed as something a business could deduct. That is now permanent. There are some exceptions for military and intelligence personnel, but those are very limited. My favorite item on here are the new Trump accounts. So there's a tax preferred account for children under the age of 18 that's been created, effective after December 31, 2025. Annual contributions are limited to $5,000. It's indexed for inflation. These are after-tax contributions. And one interesting thing here is that the government will put in, I believe it's $1,000 for every child who's born, and the parents would have to actively elect out of that for their child not to receive that. So these work very similar to an IRA. They effectively are an IRA for the benefit of that child. They can be pulled out for some limited purposes for higher education or for a down payment on a first home. But outside of that, typically the individual can't use these funds until they retire at some point in the future. You'll notice throughout our discussion, much of the law was taking things and making them permanent. It's common in tax policy to do temporary changes when the bill gets graded for how costly it will be by the Congressional Budget Office. Making things temporary typically reduces the cost that the bill is assessed at or estimated to be. And but this bill had quite a few provisions that were permanent. Informational reporting. So there are a few items on here all of our employers should be aware of. The 1099 miscellaneous and 1099 non-employee or non-employment compensation, NEC, reporting thresholds increased from $600 up to $2,000 beginning in the year 2026. So for the calendar year 2026, the threshold is $2,000. And for the calendar year 2025, it's the threshold for issuing a 1099 is going to be $600 for either of these 1099s. This is helpful in reducing just the administrative burden on companies for reporting all of their payments. So that's very taxpayer friendly. The 1099-DA, which stands for digital assets, is not part of the One Big Beautiful Bill, but we want to highlight it here because it's new. The IRS released a draft of this form or released a copy of this form on their website in January of 2025. It will go into effect for all transactions in 2025. So in January of 2026 is when the actual 1099-DA forms will be filed. If you have digital assets, cryptocurrency, those kinds of things in your investment portfolio, you should receive these. But if you made payments in crypto or digital assets, then you may need to issue a 1099-DA. And the threshold for having to issue is very low. So if you really made any payments in a digital asset format, you should be asking questions about whether or not you need to file a Form 1099-DA. Mary?
I just wanted to follow up on what you're saying about the 1099 DA. I think people are going to be surprised at the amount of reporting they're going to get on these 1099 DAs. Unlike other things where you get that nice consolidated financial 1099 joint reporting, these are coming out transaction by transaction. So if you have a lot of trades or transactions or payments, there's going to be a lot of reporting coming through. I'm just giving you a heads up.
There will be a designated file for all the 1099 DAs that our healthcare organizations are receiving. And a lot of my organizations have, their investment portfolio for their cash or capital management, treasury management, and crypto may be part of that. So there could be quite a volume of reporting coming your way. Tip income is going to be required to be disclosed on W-2s beginning in 2025. So for the 2025 calendar year, through 2028. The same thing will apply to overtime. The IRS has not indicated how this will be reported on there. My best guess is that there will be, in box 12 in that section of the W-2, there's codes that you can put in there and you can put an amount next to it. So my guess is there will be a new code for tip income and a new code for overtime income that will get disclosed in that box 12. That would be if the world was truly simple and the IRS did it in a way that was easy for taxpayers. But we'll see. They haven't issued guidance yet on how it will be reported. Your payroll company should be working with you on what this reporting will be, what will be needed for this reporting. And with that, I'm going to transition the presentation over to Lauren to cover the tax-exempt and charitable giving provisions.
And hello to all the tax-exempt organizations that are on this call. I know now you might be perking up a little bit because I think sometimes depreciation in some of those credit conversations might not be applicable, but there is a lot in the information reporting section that is applicable that Chris just went through. And then there are some items where we're fortunate that the changes aren't as extensive as originally thought. Before I jump into those couple changes, I did want to highlight, a lot of our clients are asking questions about the overtime and tip reporting, and I've been telling them that it's something that is going to be, you're working on with your payroll team, but with those, employees, it's an employee deduction. So that reporting is going to be an employee deduction. And that's why Chris was saying it's an information return reporting. And so for those overtime, employees are going to be able to deduct $12,500 of overtime premiums from their taxable income. So it's not just that you're going to be reporting that overtime amount. You're going to have to figure out what that premium is. And the conversations I've been having with my clients are, what is the definition of overtime? Are we using the federal or the state? Because there could be differences. And so that's why as we get more information on this, it is going to be federal. So it's going to be that amount over 40 hours in a work week. So if you have somebody working overtime in a day, does that account for overtime premium that qualifies here? So, but fine, as we get more guidance, we'll provide more information, and please reach out to your advisors on that, because that is something that is retroactive and we have to figure out for the past 7 months as well. Moving along to some of the changes in the tax exempt area, fortunately, there's only a couple that we really have to consider. And so this does impact healthcare, especially the first item that I want to speak to. And that first item that I have here is reporting information and a change to the compensation reporting that Chris referenced regarding the excise tax on tax-exempt organizations under 4960. So back in for tax years starting after 12/31/2017 with the last tax law, tax-exempt organizations were required to pay an excise tax of 21% on compensation paid over $1 million or certain types of excess parachute payments to the top 5 highest paid covered employees or any other covered employees. The parachute payments applied to only cover employees. What the tax law changed, what the recent 2025 bill changed, is that now this applies to all employees. So it's not just that 21% excise tax is on your top 5 highest paid covered employees, but it's for all employees. Similarly, that parachute payment, which ends up by being a payment that's over, that's calculated over a person's base compensation, would be applicable to any employee. So what the impact is here is that organizations might have more people looped into that remuneration calculation of what's over $1 million. It's not just your top 5, but it's anyone within your organization's ecosystem. And then, looking at those severance payments, we were just looking at severance payments that were higher severance payments to covered employees. That could trickle down to, any employee if you're paying an excess parachute payment that's over a certain amount. I believe it's 3 times the base compensation of an individual. So that's one big impact, and that, for our health systems and larger healthcare organizations, that's something that's going to be fairly impactful. The other item that we have here is connected to higher education, so less applicable to healthcare systems unless you're an academic medical center. And that just amends what the excise tax reporting is for the college endowment tax. And that change here is that it's gone from basically a flat 1.4% for certain applicable organizations that have, a net endowment of over $500,000 per student. That's gone from a flat 1.4% for all organizations to a tiered system that's based on that endowment per student number. Fortunately, it did increase the number of students that, when you're looking at your school and your endowment or your student enrollment, that student enrollment, you'd have to have over 3,000 students enrolled for this to apply to your organization. So that kicks out a lot of smaller universities and colleges, but something to consider is that it's going to be an expanded endowment. So something to watch out for other organizations. We are seeing also an impact to charitable giving. And so that is something that's going to roll out to tax-exempt organizations as some of those changes and some of the considerations to charitable giving from an individual and corporate perspective are factored in. The changes that we have are that for corporations, in addition to the ceiling that exists and remains of 10% of an organization's taxable income, there's essentially a cap on charitable contribution deductions for corporations of 10%. Now there's a floor that exists. So there's a 1% floor against taxable income. So a corporation cannot deduct that first 1% of their charitable contributions, but that, between 1 and 9% based on their taxable income, they can deduct. That'll impact organizations that have tax-exempt organizations directly that report unrelated business income as well. That will impact their charitable deduction that they can take for grants that they give out. On the individual giving perspective, individuals, there's a little bit of a shift in itemized deductions. I think that we're not going to cover that in detail here, but there are some changes that reduce its incentives to give for itemizers. The first one is a 5% floor against AGI for individuals. So what that floor means against AGI is that if you have an individual that has $100,000 of adjusted gross income, they're not going to be able to deduct their first $500 in charitable gifts. So only those in excess of that $500 would be deducted. And then, when it comes to, they still remain at that 60% limitation against AGI. And the offset of that is that more people are going to be able to take charitable deductions because there is going to be an above the line charitable deduction of $1,000 for single filers, $2,000 for married filing jointly couples. So just some changes to watch out for. We're going to go into this more. We have a couple other webinars happening in the tax exempt world that would focus specifically on this. So if there's other questions that you have on that, please feel free to reach out. And back to Chris for, yes.
Oh, just real quickly on this one, particularly in a year that a company or an individual has a large transaction, it's common for there to be charitable giving as a tax strategy in that year where there's a huge influx of income they're reporting on their tax returns. And it will be interesting to see how this particular issue impacts the charitable giving for that subset, because it may not be a large number of people in any given year, but the amount that they have at their disposal for giving is quite large.
Absolutely. We're going to see a shift to strategy, both for companies, with their floor and their limitations, but especially for individuals and their giving. And so it's something to consider what those might be. We might be looking at more batched contributions. People might be more excited about, contributions to capital campaigns rather than doing fewer every year, maybe more batched contributions or using donor advised funds to support giving. So it's interesting to see what might change.
Sounds good.
All right. And so we do have a polling question.
Yes, so the second polling question is, the One Big Beautiful Bill Act adds charitable contribution floors for which of the following types of donors? And your options are individuals, corporations, partnerships, both A and B, or none of the above. And then just a quick reminder that if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions.
Hopefully you were paying attention. But if you get it wrong, that's okay too. You still get credit.
All right, a few more seconds here. Make sure to hit that submit button so that it registers your response. All right, here are the results.
Great. All right, Mary, you going to take it away from here?
I will take it away from here. It was a little bit of a trick question because while the floor does not directly impact partnerships, if you've impacted charitable contributions that flow through to individuals, then you have limited your contributions. So I guess all different types of people are impacted. I will run through a few of the individual and estate tax provisions. As we've mentioned, this is a series of webinars, so we're not going to go too into depth, but almost everyone on this call is filing their own individual tax returns, so I know some of these will be of interest to people. I've had several clients ask me, so are my taxes going down? And for those higher individual taxpayers, the answer is your taxes aren't going up. So that's a good thing. It's a positive bill. But for a lot of the higher income taxpayers, it's basically that the provisions, as Chris said earlier, did not expire. They're still in place. You still have the same tax rates, and that's beneficial for everybody. We will see that there are some beneficial provisions for the lower income or the middle income taxpayers, which are beneficial. So for this year, the 2026 rates would have reverted back to what they were pre-TCJA, but they have not. So under the new law, the rates structure is going to stay the same. A few other items to note: the standard deduction is also between 2018 and 2025, it was $24,000 for married filing joint, $12,000 for single taxpayers. That was going to revert backwards, but now that has been maintained and indexed for inflation. So now it will be $31,500 for joint taxpayers. The personal exemption, for those of you who used to do your tax return in the past, you used to get a personal exemption for yourself, your spouse, your dependents. That in TCJA was sort of frozen. It wasn't removed from the law, but it basically, in most cases, people didn't have it. That actually has gone away. So in its place is now the 65 or older deduction for people. This was sort of the workaround for not taxing Social Security. With the reconciliation bill, you can't touch Social Security. So this was sort of a workaround. So there is now a $6,000 deduction on top of the standard deduction for individuals 65 or older and their spouses. That is reduced for taxpayers starting at $75,000 for single taxpayers or $150,000 joint taxpayers. It's reduced by 6%, so it is a sliding scale going down. The other thing that came into place is there used to be, there was the P's limitation, and that was basically the phase out of the itemized deductions for your higher income taxpayers. While that has gone away, they have put in basically a rate cap. So for the people in the 37% bracket, you're going to be limited to a deduction at the 35% rate. There's going to be a formulaic mechanism to do that. So For high income taxpayers in that top rate, there will be sort of a haircut of 2% on the amount of benefit you're going to get from the itemized deduction. One thing that's not included in that part of the limitation is, as Sarah spoke about earlier, the 199 CAP-A deduction, the QBI deduction, that won't be relevant there. So you're not going to get the haircut on that piece of it. Moving on to the SALT cap. So this was controversial, back and forth, all different renditions of this. So what has been enacted in the law is that the SALT cap, which was $10,000, is now $40,000. So basically your state, local taxes, your property taxes, all of that type of things, if you are an itemizer, is now limited to $40,000 over $10,000. That is indexed for inflation. I believe it's going up 1% a year. And it is set to sunset through in 2029. There is a caveat. If you are at $500,000 in adjusted gross income, then it is going to phase out from between $500,000 and $600,000. So at $600,000, the benefit will go back to $10,000. So basically, someone under $500,000 will get a benefit if they have taxes of up to $40,000. If they have over $600,000, their SALT limit is the same as it is today at $10,000. So this is going to make a lot of planning opportunities this year. I think a lot of people are going to have to look. So maybe some people are going to rethink their answer to that question earlier on that says, do you have any planning to do because of this provision? Generally, the pass-through entity tax that were put in at partnership levels that many, many healthcare organizations avail themselves of allow to take a deduction at the federal level, at the entity level for the state taxes paid. That is still in effect, and it does provide a benefit. But in some cases, there's a haircut on that. So maybe I just use Connecticut as an example. There is an 87% credit based on your 100%. So you lose a little bit of money along the way. So there's going to be a lot of planning opportunities depending on the type of entity you have. You know, are you a solely owned partnership entity where you do all the individuals and stuff together with lower income numbers? Maybe with the $40,000 SALT cap at the individual level, it's going to be more beneficial for you to opt out of the PET regime. Maybe you're a larger taxpayer where there's all these things going on, a lot of moving parts, a lot of dollar amounts. People are going to scale out of the $40,000, then you'd want to opt in. Interesting, because some of these states you have to opt into in advance, others that you don't. So my point is you're definitely going to have to work with your tax advisor to figure out what is the best situation for you. And that could change year over year depending on your income for the entity. A couple notes about this. Earlier versions of the bill, this was changing all over the place. Some healthcare organizations were going to be excluded from the ability to do PTET. I was sweating a little bit when that part of the provision came out. I was like, oh no. But luckily that didn't happen, and it does still apply to all the different types of organizations. There was also a thought that they were going to disallow the deduction for the PTET regimes at the federal level. Also, that did not pass. So lucky for us, the PTET regime is still in place. Some states do have expiring provisions, but the theory is that a lot of them, now that the bill has been passed, are probably just going to move forward and extend those provisions. Estate and gift. So I know this was a hot topic, especially if you had organizations. I have some organizations with a bunch of things where there was a thought about gifting or transferring ownership between generations. You know, the older generation was going to pass it on to their kids. They wanted to gift. They wanted to do it before the end of this tax year to make sure that they didn't lose the benefit of these increased provisions and the exemptions. It's all been extended and actually increased. So while I still encourage you, if it's right for your business, to do this sort of planning and to move things and to start some sort of gifting regime, we don't have that time constraint of having to get everything done by the end of the year because the higher amounts are still in place and they're increased. One planning tip here, though, is to go back and look at some of your documents out there, because if dollar amounts were set based on the old provisions, there may be some ability to tweak them and to change them to maximize it, to go from the 13.99 now up to the $15 million. Other provisions impacting individuals. Some of these we've already spoke about, the tip income and the overtime income. Those are both, as mentioned before, provisions that will be reported to you from your employer. You are going to take a deduction on your individual return. It's not an itemized deduction, it's a above the line deduction. I also do a lot of work with not-for-profit organizations, and there was a concern that they were going to have to start reporting this included in their Schedule J's and their Part 7s as non-taxable compensation. But this is all coming through from the organization as compensation, and it's going to be a deduction that's taken on the individual level. So I think that, other than the reporting has been mentioned a couple times, it's something that will be here. There's an actual interesting deduction that's out there for car loan interest. So if you're buying a passenger car, truck, van, minivan, motorcycle, that was, the final assembly was all in the United States, then basically they're going to have an ability to deduct interest expense on those type of cars. So it's an interesting provision, because basically what it's doing is allowing you, it could make a decision to somebody that if they're going to finance two cars and one is made in the United States and they get a tax benefit for the deduction of the interest, it's beneficial to them. There will be a reporting that is coming out from the financing companies on this about it. That won't impact most of your organizations because you're not the finance company doing the car, so that's not going to directly do healthcare. And we've already spoken about the different charitable contributions. There's a lot of individual provisions out there, and as we said, more guidance is coming out on these all the time. So we'll continue to keep you informed as things develop. And now we have another polling question.
All right, thank you, Mary. So the third polling question is tax planning for the individual and estate tax provisions for the OBBBA is relevant to me. A, strongly agree, B, agree, C, there's one or two items that I need to pay attention to, or D, disagree or not applicable. And then also, while you're responding, just a reminder that you do have the option to submit questions for our presenters in the Q&A window. Any that we don't get to today, we will try and incorporate in our roundtable webcast that's August 13th. All right, we're going to close this out here shortly since we're running short on time here. And here are the results.
Wonderful. It looks like, again, at least most people have a few items on here that will be applicable to them or to some of the providers that you support in your healthcare organizations. We're going to briefly cover the healthcare revenue and reimbursement environment as a result of the One Big Beautiful Bill Act. I do want to caveat that in our August 13th discussion, we're going to spend a lot more time in this area. There was a question in the Q&A from someone about the provider tax changes, which is the state excise tax levied against providers to help fund the Medicaid programs. And there are some restrictions in the One Big Beautiful Bill Act on the ability of states to do that, or the extent to which they can do it. And so there's going to be a lot of interaction between what the federal government is funding for Medicaid and what the states are going to then have to do to fund some of those programs. Immediately, we're not going to see many Medicaid reimbursement impacts from the One Big Beautiful Bill. So most of these provisions get phased in over a period of time. But some of the highlights, Medicaid reimbursements are the primary impact point. So there are reductions in certain federal Medicaid spending. And so the state's going to have to decide whether they're going to make up that difference, whether they're going to restrict eligibility. We do expect, and this has been anticipated for a period of time, and people have been moving in this direction for a period of time, but we do expect many of our healthcare organizations that have heavy Medicaid exposure to have some sort of pay-or mix shift, so that they're going to shift away from Medicaid, at least to a limited extent or a certain extent, to reduce the impact of the reimbursement costs. This fourth bullet point is really important. The expectation is that uncompensated care will likely increase due to some of the changes to from the Affordable Care Act changes and the sunsetting of enhanced ACA subsidies. So we are expecting hospitals and health systems, really all providers, to have a higher amount of uncompensated care. On August 13th, we'll talk more about some of the strategies around how you report this, particularly for tax-exempt organizations. There's an environment right now where demonstrating community benefit, demonstrating your charity care, this is important. And that's something that's being scrutinized by both political parties in Congress. It's been talked about for several years, and so we're going to have a panel discussing that on August 13th. There is a rural hospital fund that's been introduced. It is intended to soften the impact to rural communities and their healthcare systems that are often more challenged than they are in higher populated areas. So there's $10 billion annually for 5 years to help address some of the coverage and payment issues to those rural communities. How that gets implemented and how effective that is remains to be seen, but it's important. Without congressional action, so if no further acts are taken, there will be significant sequestration cuts to the Medicare payments that are going to be triggered. We've heard members of Congress talk about supplemental legislation they expect to work on later this year that will address healthcare funding, including some of these sequestration issues, as well as some tax and Medicaid policy issues, which they were not able to get into the One Big Beautiful Bill. And so there's a lot more that is happening right now. It's important to stay close to your lobbying organizations and make sure that they are communicating the needs of your organization to those in Congress. We're going to get to our last polling question to make sure everybody gets their CPE credit. The One Big Beautiful Bill Act will have a significant impact on provider payments, payer mix, and uncompensated care levels. Which of these areas are you most interested in learning more about? Provider reimbursement changes, Medicaid, Medicare, and Affordable Care Act enrollment and coverage changes, uncompensated care and community benefit reporting, or all of the above? And the polling question is live. I'm seeing people answer. Just wait another few seconds, see if we can get some more people to submit their answers so we can get CPE taken care of, and then we'll have a final wrap. All right, with that, it looks like most people, the highest area is all of the above. I think our August 13th panel will be really focused on these areas. I think it'll be applicable to those in this discussion. Some of the key takeaways, there's a lot that's going to be coming out. The IRS will be issuing guidance, regulations, and so forth. There's upcoming legislation that will impact both tax and healthcare revenues through Medicaid and Medicare that will be coming up in Q3 and Q4 of this year. So we'll be in touch and hope to stay close to you. I do want to highlight, we do have, as Baker Tilly, we have resources for you on the implications of the bill, some summaries, some future webinars. We also have our Executive Healthcare Conference. This is our 30th anniversary of the conference. It will be happening November 12th through 14th in Las Vegas. That's a wonderful time to be in Vegas, by the way. We have, it's a wonderful group of executives, C-suite folks from the health system and hospital space, from medical group physician, dental providers, ancillary, insurance, long-term care, a whole host, it's a broad range of healthcare organizations, and really wonderful event. We look forward to seeing you there. Here's a highlight of some of the key areas that will be covered with that webcast. And with that, I want to thank everyone for participating. We're at time, and we'll talk to you later. Amy?
All right. Well, thank you, Chris, Lauren, Sarah, and Mary for a great presentation today. And to our audience, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks as well. And then finally, here is a link to a survey for today's presentation. Your feedback is always appreciated. And again, thank you for joining us, and take care, everyone.